So thank you all for joining in and tuning in today. So Casey, Max, how's it going today? Where are you guys calling in from?
Hey, thanks for having us, Zach. We're out of Washington State, and yeah, we do real estate multifamily investing up here in the Pacific Northwest.
Nice, nice. And Max, you're over there as well in Washington currently?
Yep, Eastern Washington, same city, about 10 minutes away from Casey, as a matter of fact. And yeah, interesting story. We're actually related. We're brother-in-law. So I'll touch on a little bit about that in a little bit as we talk about our story.
Nice, nice, nice business duo there.
Yeah, yeah.
So
He sweet talked me to let him marry my sister.
yeah. So love to start things off here. Love to learn a little bit about how you guys specifically started in this industry about real estate and investing and things along those lines, and what brought you into Tamarack Capital.
Yeah, absolutely. So I think my background's in finance. I've always been interested in investing, and about 12 years ago, I got hit with a layoff in the Great Recession, and it was my first big professional job, and I was really tied to what I was doing there. But rug got pulled out, and I was kind of lost and trying to find a job during the period of high unemployment for about 6 months. And after I landed on my feet, I kind of had my eyes opened up about, I don't want to be relying on a single W-2. And through some online research, I came across the financial independence movement and started really wanting to supercharge my investments. And during that process, I found out about the magics of real estate. I can generate cash flow and get appreciation and tax benefits. And so started trying to figure out how to invest in real estate. I was the first person in my family to even think about this. And so really I was starting from ground zero when my wife and I bought our first duplex. And since then we saw the benefits of it and haven't looked back.
Nice, nice. And what about yourself, Max? How did you dive into this?
Yeah, similar but different. So I grew up in Wisconsin and was engineer by degree, also with an MBA. But I was working at a mining company, Caterpillar. Was there for 11 years. But I always had a real big interest in business and specifically in real estate. And even at one point, consider getting my commercial brokerage license. But life is funny and tricky. And at that time, I met a girl. Her name was Jessica. Happened to be Casey's sister, who was out in Wisconsin for medical school. And we got married and had kind of a mountain of student loan debt. So decided to not make a career shift at that time. And I was making a good salary, so we kind of focused on paying that off. Meanwhile, as Casey kind of mentioned, he and his wife moved back from the west side of the state over to their hometown, Richland, here in Eastern Washington, and was in getting into entrepreneurship. And we were kind of watching from the sidelines, had a little FOMO, invested a little bit of money, but eventually just wanted to be more active in the entrepreneurial world and, decided to move out here and be part of that whole movement. And we did that for 5 years, different startups and different businesses. And then an opportunity came at the beginning of 23 where Casey kind of approached me of, solely focusing on commercial multifamily real estate. And it was perfect timing. And so we kind of started Tamarack Capital at the beginning of 23. And yeah, we're just fully committed to, opportunities in multifamily, building something meaningful for our investors and really the community as well.
Nice, very nice. That's amazing to hear how that came to be. And then Casey, I had a quick question for you. You said the first sort of real estate investment you were getting into was that duplex. Was it,
Mhm.
because I've heard about certain situations where people do this, and I was also personally interested. Some people they do like this house hacking. Was that sort of that, or was it so you were living in that duplex?
Yeah, yeah. I mean, the timing worked out perfect. My wife and I, went to grad school over in Seattle, and we were moving back, and so we were temporarily in some apartments, and we thought we were just going to buy a normal single family house. But I started running the numbers and said, well, shoot, the
Yeah.
rent on one side is going to cover our mortgage. Let's live for free, right? And then we can invest the excess. And so, really, that's what I cut my teeth on. We ended up buying a couple duplexes over that time, and
Mhm.
Then, through some business partnerships, we started investing in some commercial, retail, office. But I always really was intrigued by the advantages of larger multifamily, the apartments.
Hmm.
And so about 5 years, 6 years ago, uh, Max and I had been raising some capital for some other private equity type businesses. Um, and I said, well, what if we start raising money for these real estate deals we're doing? And so jumped in the deep end there and started raising investor capital initially through friends and family. But as we continued to grow the business and grow the network and have success, we were able to help out more people who wanted to participate in real estate, but didn't want to grind out the time of looking at deals and dealing with tenants and all that.
Yeah, yeah, definitely. That's amazing. I bet that was a amazing gateway because once you did that first duplex yourself, I just assume that it's just going after it from there. You want to get into more and more deals after that. So
Oh
that's
yeah.
great to hear.
Yeah, we got bit
And
by the
then
bug. It's pretty addicting.
oh yeah, I bet. And getting your mortgage paid for, I mean, what better thing can you ask for? So, another question, Casey, for you. I remember we spoke a little bit in the past that you were originally a CFO of a software company, and
Mhm.
just want to hear how was the transitioning from being a CFO of that software company to getting into now running this real estate investment business? Was it difficult? Was it easy? What were the changes that you experienced?
Yeah. So the business that I was in charge of on the finances was a software development service company. And so we generated our revenue off of having billable staff. In addition to that, I was also the CFO of a law firm, one of my business partners' law firms for a number of years. And it was always a challenge because I was kind of the bad guy of feeling like I had to crack the whip or how do we get more productivity and make sure we can make payroll. And while we were also investing in real estate on the side, I just saw that, I was getting a little tired of going into the holiday season. People take time off, revenue drops, and I didn't really have a good Christmas or New Year for a good number of years, just worrying about making payroll come January. And I saw that our real estate investments were just tried and true, just churning out revenue. And um, that was really what kind of spurred that transition was wanting to have a little bit less stress and a little more predictability on cash flow.
Very nice. And then in this business that you're doing now, I heard from like an inside source that there's a book coming out on what you're really about with real estate and investing in real estate. So love to hear kind of what's the creative process going into that right now, and also uh, what's the book about? What's the topics going to be?
Yeah, so we're releasing the book in Q1. It's titled RealFi, Achieving or Accelerating Financial Independence Through Real Estate Investing. And it came about really as a passion project between two areas I love, real estate and financial independence and creating passive income. They're very well aligned, one feeds into each other, but I had both, conversations with investors, with my friends about, what are we trying to like how are you guys doing this? How are you investing? What is financial independence? And I realized through those conversations that just being a geek and researching the heck out of this for the past 10, 12 years, I developed a lot of knowledge I want to be able to pass on. In addition, I got two boys. They're 7 and 9 years old, and we're already talking about real estate investing and just investing in general. And, um, I want them to have kind of a roadmap of what their mom and I did to get where we are, and just something they can look back on and use as a kind of a primer for, jumpstarting their education and their investing journey.
Nice, nice. Well, let me know when that releases. If you want to send me a copy, I'll be
Heck
happy to
yeah,
take one.
absolutely.
And yeah, I'd love to dive into that because real estate is one of the best investments that I personally see out there. And especially with retirement accounts, investing with tax advantage funds into these things. I mean,
Hmm.
it's really endless, the benefits of this. So, yeah, the next thing I wanted to get into is really for both of you. I talk about this a lot with professionals and some of the clients over on our side about sort of real benefits of self-directed IRAs and going into real estate directly. And I have to let them all know Madison Trust is a passive custodian, so we can't really provide any tax, legal, or financial advice to our clients or anybody. And it's always important to just consult with financial professionals out there. but love to hear from your guys' perspective. What's your take on the benefits of real estate investments, either personally or with retirement funds?
Mhm.
And what's good with hedging against the stock market possibly?
Yeah, well, I mean, I think first and foremost, I think that everybody should have some of their portfolio into real estate. You kind of said it. I see it as a hedge against the stock market. When you look at what environments do stocks perform well in, it's when you have obviously high employment, high earnings growth, and lower interest rates. But what happens is during a recession, those earnings decrease, consumers spend less, there's job layoffs. And what the Fed does is they lower the interest rate to try and spur the economic activity. Real estate, likewise, also does extremely well when interest rates drop. And so if you're seeing a recession-induced drop in interest rates, the stock market's going to be suffering because of the fundamentals. But real estate's actually going to outperform because you're going to have a lower interest rate environment, which boosts up asset prices. You get more cash flow, you can refinance into a lower interest rate. And so I see these two things, these two different asset classes working in tandem to get you a bit of diversification. The second part is, looking at using just straight normal cash versus a tax preferred account or a self-directed IRA. And we have a couple different profiles of investors. There's the older guys are extremely wealthy, maybe they're CEOs or own their own business, and they're able to write $250,000, $500,000 checks because of their asset resources. But we also see people who are earlier in their investment journey, in their 30s, 20s, or 40s, and they're working their W-2 job. They're focusing on max out their IRA every year, but they don't have 100K sitting around to just participate with us. And so it's really actually one of my favorite things when I can help work with them and educate them. There's this whole thing called self-directed IRA. You've been investing diligently for 10, 15 years, and you got $500,000 or more in your IRA. You can actually take out a small portion of that and allocate it, still keep the tax benefits, but are able to participate in real estate investments that you otherwise wouldn't have the resources to invest in.
Nice, nice. And Max, I'd love to hear your thoughts on this as well.
Yeah, I mean, definitely from a less technical aspect, I just look at it from a demand standpoint, right? Especially in growing markets where we are. The land isn't producing anymore. So your footprint of where you can build is limited. And real estate, people need places to live. I mean, we have a housing shortage of how many millions nationwide, locally here. We have a ton of housing needs. And it just excites me to know that we can provide quality living for a need that people are looking for, and that in and of itself is a great hedge against, especially if you're doing self-directed IRAs into individual stocks. You have no idea what that particular stock's going to do. The next company comes along, AI stock comes along, and next thing you know, that sentiment of your stock that you invested in has tanked. Whereas real estate, you might not get that 10x growth, but you're going to get that true, 15% consistent growth year over year.
Yeah, I'd like to add on that. One, I've proven to myself that I'm terrible at picking stocks, so I just stick to the S&P 500 index and focus on what I can control, which is real estate investments. But Max hit on a really important point, is that we do have a national housing shortage, and when our investment thesis and strategy is not just let's go find an apartment and buy it, but we find apartments that have been mismanaged or the current owners haven't kept up on maintenance. And so we're able to go in there and not just acquire the property, but have the budget in place where we can go and make improvements in the units, new flooring, make it nice, fix any like material damages that have been there. And like, for example, we just closed on a 102 units in Pullman, Washington, which is home to Washington State University. And one of the apartments, out of the 51 units, it was only 40% occupied. So it had 30 units that were just sitting there, prime units. They just needed some tender loving care, and then we can bring more housing to the community. So it's a great example where we can actually invest through a strategy that creates great investor returns, while also helping the community out by providing quality housing stock and making sure that doesn't go dilapidated and out of use. And we kind of look at it as, some people like to flip houses. It's kind of like flipping apartments, right? We buy it,
Yeah.
we rehab it, fix it up, and we have kind of a 5-year plan hold period. And then we can refinance or sell to get the funds back to the investors. But it's one of the really, really fun parts about what we do.
Yeah,
Yeah,
and if
no,
I can just also add just on that value add component of it, and why I think we both believe strongly in that is the fact, especially today where construction prices are. I mean, Casey and I looked at a deal last year where we were buying 50 units, about it's under 50 units for like 100 and what was it, 160 a unit, and it had another acre of land that we could develop, and we were getting estimates for building units on there, and it was over 200 and some dollars a square foot, or 200,000 a square foot versus 160,000 a unit. And so the value add component of that, like we are building in, equity just by buying the land that already exists or property that already exists versus starting from, a greenfield. And so there's just, I think, more opportunities in this approach versus new construction as well.
Yeah, you can imagine if we're buying it for 160,000, putting 20,000 in, so you're in it for 180,000, now it's worth 210,000. That built-in equity is really fundamental for growing people's net worths. We don't just look at cash flow. Obviously, we like cash flow, but we
mhm.
see that equity increase is what's instrumental to helping achieve financial goals for people.
Exactly. Yeah. Well, I think that's a great model that you guys have going on there. And would love to hear kind of on this. What do you think the trend is going to be in real estate, in this real estate market in these upcoming years? I know we're just in 2025 now. Like you were saying, we're seeing some interest rates lower. So love to hear what the trends do you think are going to happen? What trends are you seeing currently for the
Mhm.
next couple years?
Yeah, well, each market has its own specific quirks and things to look for, but on a macro sense, I think we have two different dynamics working here. One is on the longer term horizon. We have the millennials are reaching the peak household formation. We already touched on there's a couple million housing units short, both across single family houses and apartments. And I think last year in 2024, we only knocked that deficit down by 400,000. I think we built 1.4 million new housing units, and a million of that was just organically what's needed for population change. So there's going to be a long-term need for housing that's going to create long-term demand, pressures on rents, and everything that we can't quickly build our way out of. In the near term, we've had interest rate impacts on asset prices. Everyone knows that the debt was practically free. Interest rates were so low in after the pandemic, 2021, 2022, and then the Fed increased the rates by 500 basis points, 5%. And what that does is it just kills the value of these assets, right? I mean, if you're buying something that produces, we call it a cap rate, but essentially think of it as your cash on cash if you bought it with no debt on it. If you're seeing, for example, a cap rate of 4%, but you have to borrow at 6%, there's no way you can make that deal happen, right? So what we saw was one, transaction volume dropped 80%. Not, I mean, it was 1/5 of what it was before the interest rates increased. And that's just because if you didn't have to sell, you're not going to sell at a discount. And if you're trying to buy, you can't buy with these, previously inflated asset prices. So that's starting to work its way out. We've actually seen net operating income based valuations decrease about 30%. So it's a great time to be entering into the market. But the challenge has been no one's selling unless they are forced to sell, like their debt's coming due or they're in distress. Everyone wanted to just kind of, kick the can down the road and hold out until 2025, 2026, when they thought interest rates would drop quickly back to where they were and asset prices would reinflate. What we've seen, though, is the economy has still done exceedingly well despite high interest rates. Unemployment's low, GDP's chugging along, and inflation's not kicked. So whereas a year ago, we all thought that 2024 was going to see, I think, 5 drops in the interest rate. I think we had 2, if I recall. And the expectation for 2025 is, I mean, shoot, is it going to drop at all? Could it go up? And so what this has done is it's changed the expectations of the sellers, where it's like, things might not ever return back to where they were during the pandemic. And if you got to sell, you got to sell, but you're not going to, that was a once in a lifetime jump in asset prices. So we're seeing more sellers come to the market. We're seeing buying opportunities, and it's one of the most exciting years that we've seen potentially ever.
Nice, nice. And Max, do you have a similar look on the trends? Do you have any other
Yeah,
ideas
I
or
mean,
any
just
insights there?
speaking, directly to Eastern Washington, looking at some of the data that that we have access to, and we've seen the cap rates rise steadily over the last, 8 quarters, and they're pretty much plateauing out, is what we believe or what I believe. We're kind of seeing them stabilize, and depending again on what interest rates do, we should continue to see those kind of start maybe trending down to where, back to the normal or the historical average. And so we're looking forward to that, especially if this new administration, says, does what they say they're going to do. I don't know if they can force the Fed to lower rates, but that would be good for us and Horizon. But yeah, I mean, just talking about some of the sales volume that Casey was just hitting on. I mean, I haven't seen the full year data for Eastern Washington, but at Q3 we've already exceeded, total sales from the prior year, and I expect 2025, it's going to start going back up, getting close to the 2022 numbers. Just more people are investing in real estate, and the more people that come into the market is a good thing kind of for all. We're going to see, more more pressure to buy things, which should hopefully increase prices as well. And again, with that demand of people needing places to live, we should still continue to see rent increases. Looking specifically here, vacancy is up a little bit, but that's to be expected. It's up mostly everywhere just because of the large supply of new construction that came online. But at the same time, average rents have continued to increase over that time. So that means that we're slowly absorbing the stuff that's coming to market, while still having a nice bump in rents as well.
I'd like to touch also on our market. So we're Eastern Washington. So if you know of Washington State, Seattle, Tacoma, they're over on the west side of the state, and then we have this big mountain. It's called the Cascade Mountain Range that divides us in half. And so our side of the state is tertiary or secondary markets, and a lot of ag, and we have this Columbia River that runs through our state. I don't know if you guys in New Jersey have heard about it, but it's one of the largest rivers in our country. And what's happened is that we have this AI boom. We need cheap electricity. We need hopefully clean electricity to run all of these data centers, these data warehouses, cloud computing. And so we've had really a silicon gold rush of the Facebook, the Metas, Alphabet, Microsoft, just doing land grabs over here to build these gigantic data centers next to this hydroelectric power. And obviously, when you're looking at the fundamentals of what drives your real estate prices, it's demand, it's jobs, and it's good incomes. And so we see that we're really well positioned, boots on the ground in these markets. We know the markets, we know the people to provide investment opportunities that are capitalizing on this. It's almost the Max and I kind of joke around of, we don't want to go and speculate for gold. We want to be the selling the gold pans, and really by investing in the real estate here, that's kind of how we're pulling that off.
Nice, nice. Yeah, no, I think you guys have a great business model over there in Washington. So love to hear, with the real estate markets thriving in these recent times and going to be thriving moving forward. How does somebody really start to get into this, especially if they want to do it personally or if they want to do it through a self-directed IRA? Do you think if somebody is a little confused about it, do you think it might be a good idea to start with a syndication investment and get a little knowledge, and then possibly, if they are willing to enough or if they have enough capital, venture off into their own deals as well?
Yeah, I see that there being really three main ways to get into real estate investing. The lowest risk and the easiest is essentially what I did starting out. Buy a small multifamily, anything 4 units or lower. You can use really great Fannie Mae debt. You can get 30 years fixed, high leverage. And if you're living in it, you're essentially subsidizing your own investment risk, right? And so if you don't have a lot of capital or you're willing to move, I would, for my kids, I want to recommend that they buy a new 2 to 4 plex every year, get another, 5% down and fix it up a little bit. I think that's just a very solid way to do it. But not everybody's willing to move and do this. If you have more substantial capital availability, or maybe you got some other friends who want to go in and you each throw in 100,000 into an investment, that's a great way. If you can get 5 individuals to invest 100,000 each, you could buy a pretty healthy little, 10, 15 plex, something in the 1.5 to $2 million range. And that's a great way to do it too. But you need to have obviously the capital resources, the knowledge, the willing to be active in your investment. So there's pros and cons to that as well. Also, I would say there's a lot of extra hurdles investing into real estate that you're actively managing when it's a self-directed IRA.
Mhm.
I have a self-directed IRA through Madison. Thank you guys. And I didn't invest in our deals at all. I invest in other syndicators deals because if you misstep and do what's called a disallowed transaction or disallowed activities, then the IRS might just yank the rug out and say, no, that's not an IRA anymore. That's just normal funds. And you lose that tax preference. And that's really scary. And so things like a perfect example is, um, if you buy an apartment yourself through self-directed funds and you do the property management, well, the IRS says you need to pay yourself a market wage on that.
Mhm.
Then, otherwise you're essentially not taking money yourself and leaving that in your IRA, and they view that as an illegal contribution, right? And there's
Mhm.
all these little quirks where if you don't know them very well, you can kind of get yourself into trouble. And so the third way, which I think is the safest and easiest, is to invest with syndicators who can structure this deal, and you can focus on what you do best, which is your career. And whether you're a professional or a W-2, you can continue to grow that and grow your income, and not be actively managed. It also helps you diversify a bit more across different operators or different deals. And so I think that if you're using self-directed funds, that's probably how I'd recommend doing it. It's just safer and easier.
Yeah, no, I definitely agree. It's a little tricky out there, making sure you got to follow all the regulations, look at the IRS codes and things along those lines so you don't do any prohibited transactions or anything like that. So yeah, people do love to do it and it's very beneficial if you do it directly into real estate. I definitely agree with that. But if people are probably looking for a more passive investment where they could kind of just put their money in a real estate investment, not worry too much about it because they're not owning that property, they don't have to work with a third party to manage it and pay
Mhm.
them through their IRA. Syndications are definitely one of the most popular ways to go is to get into those syndications and let them do the work for you and you get to
Right.
collect the benefits.
Exactly.
So yeah, no, that's great to hear there.
And,
Um,
and, and I would add as well, real quick, too, that,
yeah,
when you're investing with the syndicator who's doing this full time, they're going to get, our broker network gives us first glance at deals, right? And they know that we can close on it, so they want to bring us the best deals. We also have active strategies like this value add where we can force the appreciation of these assets up. And so a lot of times what you'll see is that obviously there's a extra cost and a fee structure by investing with syndicators, but the network and getting the best deals and an active investment strategy, you can actually get much better returns than maybe buying on your own and having your own headache to deal with. So
yeah.
it's always interesting to look at that.
Yeah, I definitely agree with that myself personally. It makes total sense. Yeah, thank you guys so much for joining in today. I mean, this was very insightful. Loving to hear about your guys' insights on the real estate market. It's great to talk to professionals.